Right traders, welcome back to the Liquid FX YouTube channel. Here I'm going to be addressing a question that I got today from one of the Discord that I'm currently in. And this is the concept of structure, specifically lower time frame structure, and how best you can use it with the rest of the concepts within ICT. Right, so let's get started. So here we have the NASDAQ 5-minute time frame. Again, I'm going to be dissecting a NASDAQ long trade that you could have taken. I believe this was last week's price action. Right, I personally trade the S&P 500. So for those who trade NASDAQ or the S&P 500, this should be useful for everyone, but this is going to be aimed at using and utilizing lower time frame structure. So just quickly before we go to the actual market itself, right? Structure, of course, has two forms. We have bullish structure, which is on the left of your screen. So we have new highs and lower highs and new highs and lower highs and new highs, right? So this is bullish structure. And of course we have bearish structure, right? We have lows and lower highs and new lows and lower highs and new lows and lower highs, right? So it's the same concept, just flipped on its head, right? So from here we need to understand that although these are opposites in terms of structure, the actual rules in which we mark them out are basically the same. Now, what do I mean by that? Now, when it comes to marking out structure, there's two rules that we must adhere to. There's two main rules. The first rule is that we must have sharp moves up and sharp moves down, right? So you want to see the price action give almost V's and inverted V's. So you're looking for sharp movements in price, okay? Sharp moves up and sharp moves down, right? Very important. Sharp movements are critical to determining accurate structure, right? So that's the first thing. And what we see over here is we see sharp moves over here, right? So this typically represents the sharp moves, right? So we see these sharp moves here. I'm going to label it in green. So we see sharp moves over here. We see sharp moves over here. And we see sharp moves over here. So we need to see that V-shaped in price, right? You need to see that V-shape. Now, exactly the same is for bearish structure, right? For the bearish structure, we want to see the inverse V-shape, right? So the lower highs must have that inverse V-shape, right? So I'm going to label this in red. So we must have, again, sharp moves up, sharp moves down, right? Sharp moves up, sharp moves down. So that's the most important thing. So what you want to avoid is a price action movement that looks something like this, right? Let's say we're in a bullish trend. You want to avoid structural peaks that often look like this, right? You want to avoid this stuff over here. So I personally wouldn't mark this as a lower high. I wouldn't mark that as a lower high because it's a range. You can see it's built liquidity. So we understand from a liquidity concept that this here will be liquidity, and quite often price will look to sweep this liquidity before heading higher. So you want to avoid the price movements that are not sharp. So you want to have sharp moves up and sharp moves down to determine an overall swing high in the markets. Now, the second thing which you need to consider is the fact that we must have at least 2 candles for a pullback, right? At least 2 candles for a pullback. At least 2 candles, preferably more than 2 candles, but we want to have at least 2 candles or more for it to be considered a valid pullback. So what do I mean by that? So what we are essentially looking for now in price is we want to see the price action, right? We want to see these pullbacks over here. So if I quickly zoom in, we want to see this region give us 2 or more candles as a pullback. We want to see this region is our pullback, at least 2 candles or more. And we want to see this region over here have 2 candles or more. It's the same over here when it comes to the bearish, right? So our pullbacks must have at least 2 candles. This pullback again must have at least 2 candles. And this pullback over here must have at least 2 candles, right? So these are the main 2 rules that are very important to consider when it comes to determining an overall structural bias using the highs and lows. A quick disclaimer to consider is that your structure does not have to be 100% correct, right? It does not have to be 100% correct, right? And what do I mean by that, right? Your structure could match my structure as long as it's within the region of around 70% or more. It's okay. And the reason for that is because you will end up catching the same overall move. Because remember, you're not just using structure, you're using structure with liquidity, with fair value gaps, with time, with higher time frame narrative. So there's a lot of things that go into it. It's not just looking at structural highs and lows. And this is very important to understand. So now if we take this to the charts, again, what we have over here is we have NASDAQ from Thursday the 9th of May. So time of recording is the 16th of May. So it's about a week ago. Now, of course, here on the NASDAQ, we start with the Asian range. So the Asian range here looks to build liquidity, right? This is a low volume time of day known as our accumulation phase, right? So this here represents our, let's call this the accumulation, right? So what do you need to know about the accumulation? Well, the accumulation is essentially a low volume time of day that essentially builds liquidity. Now, from here, there's 2 distinct regions we use, right? We use the Asian low, which is down here, and we use the Asian high, which is up here. So again, this is where we begin to mark out our structure, right? How did I look at structure this day, or how should you be looking at structure this day? Let's begin to mark it out. Okay, so again, what we have over here, if I make this a little bit clearer for people, what we have here is we have 5-minute structure. This is the 5-minute time frame. So if we zoom into price action and get a real quick and clear indication, how I would mark structures like this. What we have here is we have a structural low down here. The yellow dot represents a structural low. Now from here we have price giving a structural high. Now what determines this as a pullback? Well, let's see. The move here is very sharp. We have a very sharp move. I'm sure most people would agree to that. We have a sharp move up. And we have, more importantly, we have 2 candles as the pullback, right? They're very important. So this here validates our overall structural move, okay? So if we now continue moving on with price, what we have over here is we have price giving us a structural high, then we see price giving us a structural low, right? So what we have, structural low, structural high, structural low. Now from here again, we've had 2 candles as a pullback, 2 or more candles, so we actually 3 candles to be precise. Now we have a structural high. Now from here we have a structural low that's all the way down here, okay? There. Now from here, another quick thing to notice is that notice how each of the structural breaks occur with body. So this is a body break over here. We see price breaking with a body. Again, we see price over here breaking with a body. Now from here, we see price moving to the upside. So what we see over here is we see a bullish break to the upside. So this is a boss in the opposite direction, okay? This is a bullish break of structure, just like this. So from here, again, we continue to follow our structure. Again, we have a structural high over here. We have a structural low just down here. Again, we have more than 2 candles. We have a sharp move up and we have a sharp move down. This signifies a structural leg in the market and a structural pullback. 2 candles or more, sharp move ups and sharp moves down. Now from here, we continue the same overall trend, right? So now we have a structural high and we have a structural low. Okay, now if we continue the trend upwards, again, we have a structural high over here, right? Structural low, which gave rise now to a structural high. Okay, now from here, some people are going to argue, okay, we've had a break to the downside. Cool. Again, bearing in mind the low of the day currently is over here. So yes, we've had a break to the downside. This is a valid break of structure to the downside, right? Now from here, again, this gives rise to a structural low down here. This is a structural low in the markets, okay? Now from here, this high gets broken. So now we have a structural high to deal with, right? So now we're back bullish. We're back bullish. Again, this is the NASDAQ, so it's quite a volatile pair compared to that of the S&P, sorry. The US 30 is quite volatile itself. So as you can see, this is the overall outlook of the structure, right? Notice how, if we quickly mark this up, we have sharp moves down, sharp moves up, sharp moves down, sharp moves up, down, up, down, up. Now from here, it's important to understand, yes, we've had a bearish break of structure, but this then gets trumped by a bullish break of structure. So you need to understand that overall, the 2 things you want to look for is you need to look for price to give at least 2 candles for a pullback, and you have to look for price to break with a body as long as having its sharp moves up and down, right? So from here, as the narrative was bullish, right, how could you have taken advantage of this particular trade? So you need to understand that we have a bullish dealing range to work with over here. This is our dealing range, okay? So again, like I've banged on about in many videos in the past, right, there's 4 things we need to look for on every single time frame, right? What are those 4 things, right? We look for structure. We look for our dealing range. We look for our PD arrays. And we look for our fair value gap. So we're going to apply the same 4 principles in this market as I speak right now, right? How could you have used these 4 pillars to take advantage of the markets, right? So the structure is bullish. This video is about structure. The structure itself is bullish, right? We have a structural low down here and we have a structural high over here. So this is our dealing range, right? So the structure here is bullish. The last break of structure here was bullish. So we understand we have a bullish break of structure or a bullish shift of market structure. Now from here, this gives rise to our dealing range, right? The dealing range can be projected from this swing low up to this swing high, right? This swing low up to this swing high. Now this, of course, simultaneously gives rise to the premium and discount arrays, right? What we have over here is we have an equilibrium. Anything below is a discount, anything above is a premium. So now we need to consider our fair value gap. So where is the fair value gap? So if we look carefully in price, the fair value gap itself, I'm going to highlight here. So this is the fair value gap, right? Notice how this wick and this wick don't touch each other. Therefore, they leave a void in price. And so from here, this void will be represented in blue, right? So this is our fair value gap or our inefficiency or our void, right? This is a void in price, okay? Something to consider again is that we see how prices come to just below the equilibrium, right? Just below the equilibrium. So your best bet will be you want to be buying at the equilibrium, having your stop loss in a safe place, i.e. over here. I would have my stop loss here because there's no inefficiencies over here for price to target. Therefore, price is unlikely to come to this region, right? So once you have that in place, again, the rest of it is simply the AMD model, right? Because we have an accumulation. We have our manipulation, which is, in this case, the ICT Judah swing, right? This is a manipulation over here. We swept sell-side liquidity as a way of enticing sellers before the market does what it wants to do, which, of course, NASDAQ was bullish on this day. And then from here, the trade itself played out, I believe, to a 1 to 2 or 1 to 3. But the main thing I want people to take away from this video is to understand how we use structure, right? Structure was the main purpose of this video. Once you can understand how to determine high probability structure breaks, the difference between a liquidity sweep and a structural break will become very clear. And the way you do that simply is by starting off with these rules we came with right from the start, right? So we understand we need to have sharp moves up, sharp moves down, minimum of 2 candles as a pullback. And most importantly, if not the most important thing, is to use this in conjunction with all the other concepts, right? Such as liquidity, time, inducement, fair value gaps. It all comes together to make a fantastic recipe if you know what you're doing with basic structure.